Hello, this is Chuck Carnevale, co-founder of FastGraphs. With this video, I'm going to do a deep fundamental analysis of Abbott Labs utilizing the fundamentals analyzer software tool FastGraphs. AbbVie was spun out of Abbott Labs in early 2013, and what you see here is the combined company. This area here is not a drop in stock price for the original Abbott Labs. The area from this point back represents the combined companies, and then they split up into Abbott Labs and then AbbVie. Consequently, when you're looking at both of these companies, and I'll start with Abbott Labs here, you're only looking at the time post the spinoff or the split up, which started again in early 2013. So this is what Abbott Labs looks like currently, and then the sister company is AbbVie, which is the primary focus of this video. As I now move to AbbVie, I want to start simply and then kind of develop the fundamentals here. What you have on the graph right now is a plotting of AbbVie's earnings per share after it was spun off. Really, the numbers actually would start with the 2014 number, which is the first year the company was purely an independent company. And what I want you to focus on is the earnings growth rate was 15.1% over this time frame. So this orange line represents a PE ratio of 15.1 times each year's earnings listed below. Now, one of the things that I'm really attracted to AbbVie for is not just its growth, which has been really above average, but also its dividends. So I'm going to plot dividends here, which include the dividend payout ratio. As you can see, the dividend has increased from $1.75 to $2.10 to $2.35, and estimated to grow to $2.56 this year. You can also see that they're paying out, this area below the white line represents the portion of earnings paid out in dividends, which I'm now going to stack on top of the graph to illustrate that as a shareholder you get price appreciation, which is a function of the price moving from point A to point B, plus you get the dividend income. Now, I never actually purchased AbbVie. I received it because I had been a previous shareholder of Abbott Labs. So from the standpoint of receiving Abbott Labs in the spinoff, utilizing the calculator functionality here of FastGraphs, you can see that AbbVie has been an excellent investment, yielding just under 21% a year since the spinoff. However, I added a second green dot here because I think it's important. I wrote an article on AbbVie, which I linked to in the written portion of this article on April 8th, 2015, when the price was approximately 58. The performance since that time has been quite acceptable, averaging 12.2% per year. The $10,000 would have grown to just under $12,000, averaging almost 20% of growth over this time frame. I would have received, on a $10,000 original investment, shareholders would have also received $857 in dividends for a total growth plus dividend of $12,848. That's a total rate of return of 28.5%, annualized at 12.2%. So I think clearly AbbVie has been an excellent investment since it has been operating as an independent company. But I would like to point something out here as it relates to this article. The day I wrote the article, the original article, the PE ratio on Abbott Labs was 16.4. Today, the blended PE ratio is 13.7. So we've had some PE ratio contraction, but nevertheless, the stock has generated double-digit returns. Today, the reason I bring this up is because I believe it's actually a much better value today than it was when I wrote the original article. When I wrote this article, I would have called it fairly valued or fully valued. Today, I would call it modestly undervalued. So to summarize what I see in AbbVie today, it's currently available at a very attractive PE ratio, blended PE ratio of 13.7, offers a 3.6% dividend yield. It's an A-rated company, $110 billion market cap, and the one negative on this stock that many people bring up is the 87% debt to capital. So now I'm going to turn to financial underlying numbers or fund graphs and take some looks at AbbVie's debt. The dark blue bar here is long-term debt, and the mustard yellow bar is total debt. And I think what you see here is that the vast majority of AbbVie's debt is long-term debt. I've evaluated their capital structure. I might also add that interest rates on any of their near-term debt is very low, and most of their long-term debt is through notes that mature out in 2026, 2025, all the way out to 2046, with coupons or yields of between 3.2% to the highest of 5.3%. So this is very attractive debt for the company, in my opinion. In their most recent conference call, management indicated in response to a question that as long as interest rates stayed as low as they are, the company was really not concerned with trying to reduce their debt. But they did talk, which is very important, they did talk about being very focused on the dividend and growing the dividend. So when I look at just the quick ratio and the current ratio, you'll see that both of them are well within acceptable ranges, over 1 in both cases, indicating that the company has no liquidity concerns or issues. Furthermore, as it relates to the ability to amortize that debt, AbbVie generates prodigious amounts of operating cash flow, which is the royal blue bars here. But the majority of their operating cash flow is also free cash flow, which is cash flow left over after operating the business. So I believe the company's debt is well manageable, and I believe their dividend is well secure going forward. Going back to fast graphs now, I think you can see clearly that AbbVie has generated excellent operating performance, very consistent earnings growth, an excellent dividend record. Their dividend has grown by over 13% per annum since they were operating as an independent company. But I think the real key is, what about the future? I think the stock is reasonably valued right now, even attractively valued in today's rather highly valued marketplace. So let's look at what the future holds. Fast graphs provide several forecasting options in looking at the stock. So I'm looking at operating earnings here. And at the bottom, you see the number of analysts listed. There are 19 analysts that were forecasting earnings for 2016. The company has a December fiscal year. There are 21 analysts forecasting earnings growth of 14.73% for this calendar and fiscal year, and the same 21 analysts forecasting earnings of 16.8% for 2018, and it drops off to 18 analysts forecasting another 13%. This is about as far out as I like to go, but one thing that this forecasting calculator allows me to do is do calculations of what might occur. So this orange line is a 15 PE ratio, and these other lines represent different PE ratios so that I can do what-if calculations. So what if AbbVie traded at approximately the 13.5 PE multiple that it currently trades at? Going out a couple of years, that would represent an 18% total annualized rate of return, assuming these earnings manifest as forecast. And if their PE went back to a more reasonable 15 PE, that would be a 26%. I can also do these calculations by utilizing the normal PE, which has actually been a little higher since it's been an independent company at about 15.8, which would give me in excess of a 30% rate of return. So I have several options here that look like the stock will be a very attractive candidate going forward as long as everything comes to pass. I can also look at a trend line growth rate where there are 9 analysts forecasting 12% growth. And going out longer term, that would indicate double-digit rates of return, assuming the company grew at these rates. But I would like to go back to the estimates calculator for a moment and review how accurate analysts have been with forecasting earnings for this company. I bring this up because there's a lot of opinions on how accurate analysts are, and my view is I don't care how accurate analysts are in the aggregate. What I really care about is how accurate analysts are on the individual stock I'm looking at. So here's the forecasting calculator that I presented in the article I wrote on April 8th, 2015. And I want you to notice that the analysts were forecasting earnings of $434 for 2015, $499 for 2016, and then at that time $547 for 2017. So let's check that against current estimates first. In order to do that, I'm going to go to the analyst scorecard that is available on FastGraphs and review how accurate those estimates actually were. In 2015, AbbVie was forecast to earn $4.37, but they actually came in at $4.29. This is a one-year forward forecast that was made in 2014. And they were forecasting $4.82 for 2016, or excuse me, the forward was $5.02, and they came in at $4.82, which was a 20-cent miss, but that's well within the 10% plus or minus margin of error that we give them. Similarly, when they were making forecasts 2 years forward, you see a very similar result. When you analyze how accurate the analysts have been, on 1 year forecast, they've been within a margin of 10% margin of error 100% of the time, and within a 2-year margin of error, a 2-year forecast margin of error of 20% 100% of the time. So thus far, the analysts have been very accurate on forecasting. Now, that doesn't mean to imply that I believe these numbers are going to be exactly correct. What it does imply, though, is I think there's a high probability that these forecasts might be within a reasonable range of accuracy going forward. Consequently, if that's true, and that is something that needs to be continuously monitored or constantly monitored as each earnings report is produced, the potential rate of return of buying this stock today appears to be quite attractive, especially when you consider the 3% dividend yield that's been growing by double-digit rates and is expected to continue growing by double-digit rates going forward. So when you add all the numbers up, I believe AbbVie looks like a very interesting dividend growth stock, and it's kind of unique in that it offers double-digit earnings growth potential, which is very rare for high-yielding dividend growth stocks, coupled with a significantly above-average 3.6% dividend yield. And as I indicated earlier, management is committed to continuing to pay and grow their dividend going forward. So I think it's the ideal situation right now in a relatively overvalued market. You've got a very reasonable valuation. As I talked about in my previous article, you've got earnings yield in excess of 7%. You've got a growing dividend and growing earnings and cash flows that would indicate that this might be a very attractive company for the dividend growth investor going forward. But as always, I recommend you do your own research and due diligence. This has been Chuck Carnevale saying thanks for listening. I hope you got something out of this presentation on AbbVie.